Welcome to the Deep Dive.
Hey there.
Today we are cracking open the Q3 2025 results from ServiceNow, the AI platform for business transformation, as they call themselves.
Yeah, and our plan is simple. Cut straight to the numbers, figure out why they beat expectations, and what this all means for the rest of their year.
Okay, let's jump right in then. Q3 performance. They didn't just meet guidance, they significantly blew past it. Pretty much across the board, right? Top line growth, profitability.
Absolutely. The big number-grabbing headlines, at least for analysts, was the non-GAAP EPS, $4.82 per diluted share.
And the estimate was?
The street was looking for $4.26. So yeah, they beat it by a solid 56 cents. That's quite a beat.
That really suggests strong execution, doesn't it? Especially when you look at the revenue. GAAP revenues hit $3,407 million.
Which is, what, 22% year-over-year growth?
Exactly, 22%. Pretty robust.
And look, this wasn't just a one-off good quarter. It gave them the confidence to raise the outlook for the whole year.
Right. That's the key signal, isn't it? Raised full year 2025 guidance.
Three critical metrics: subscription revenue, operating margin, and free cash flow. All revised upwards.
Okay, let's break those down. The subscription revenue guidance.
Yeah.
They bumped the midpoint up to $12,840 million for the full year.
Yep. $12.84 billion. And importantly, that represents 20% growth in constant currency.
So stripping out the currency fluctuations, the underlying demand is still growing at 20%. That's powerful.
It is. But maybe even more telling from an efficiency standpoint is the margin guidance.
They raised the full year non-GAAP operating margin target to 31%.
31%. And the cash generation forecast, that's also really impressive.
Tell us about the cash flow side, because, for a company growing like this, turning that revenue into actual cash is crucial.
Totally. The full year non-GAAP free cash flow margin guidance is now 34%. Here's the kicker.
Okay.
They specifically called out an expectation of 250 basis points of free cash flow margin expansion year over year.
Wow. 250 basis points. So they're not just growing, they're getting significantly more profitable as they scale.
Exactly. It tells you their platform economics are, well, rock solid. And they're attributing a lot of that efficiency gain to their internal use of AI.
Interesting. Okay, speaking of that platform, let's drill into the subscription numbers that feed that kind of optimism. Q3 subscription revenues.
$3,299 million. That's $3.3 billion, basically. Up 21.5% year over year.
And you mentioned constant currency being important.
Right. Taking out the FX noise, it was still 20.5% growth. Very consistent.
That consistency is good visibility. But for the longer-term view, the future contracted revenue, you look at RPO, right? Remaining performance obligations.
Precisely. That's the total value of contracts signed but not yet booked as revenue. It's your pipeline visibility.
And that number is huge. Total RPO hit $24.3 billion.
$24.3 billion. Growing 24% year over year, or 23% in constant currency. It's a massive backlog.
It really shows how embedded they're becoming in their customers' operations.
For sure. But even more relevant for, the next 12 months is the current RPO, the CRPO.
Right. That's the revenue they expect to recognize relatively soon.
Yeah, within the next year. And that CRPO figure was $11.35 billion.
Oh, yeah.
21% year over year, or 20.5% in constant currency. Again, very strong near-term visibility.
That's serious revenue certainty for a company this size. Few SaaS players have that.
And it's backed by landing bigger fish, right? They're not just signing small deals.
Good point. They highlighted the growth in large customers. 553 clients now spending over $5 million a year with them.
That's annual contract value, ACV, and 553 of those big ones is up 18% from last year.
So they're landing and expanding successfully within the enterprise.
Definitely. And they're closing big new deals too. Q3 saw 103 transactions over $1 million in net new ACV.
103 seven-figure deals in one quarter. That sales engine is humming.
Which brings us back to efficiency and margins. You saw that in the Q3 operating margin number 2.
Non-GAAP operating margin hit 33.5% for the quarter.
Yeah, and the leadership team was pretty direct, saying it's the platform's power combined with, quote, AI-driven efficiencies.
Okay, let's pause on the product economics for a second. Q3 non-GAAP subscription gross profit margin was 83%. 83%. What does that tell you for our listeners?
Well, it tells you a couple of really important things. First, The actual cost to deliver their software service is incredibly low compared to the price customers pay. It's an efficient platform to run.
Okay.
Second, it shows customers see huge value. They're willing to pay a premium for it, which lets ServiceNow reinvest heavily while still expanding margins. It's a strong competitive advantage.
That financial strength seems to be breeding confidence corporately, too. We saw the announcement about a stock split.
Right. The board authorized a 5-for-1 split. It still needs shareholder approval. I think the meeting's set for December 5th.
What's the typical thinking behind a split like that, making shares more accessible?
Yeah, often it's about increasing liquidity, making the share price psychologically more attractive to retail investors. But it's also a signal, right? Management confidence that the stock price has more room to run sort of underpins that strong guidance.
And they weren't just thinking about the future stock price. They were buying back shares now.
Actively repurchasing. Spent $584 million in Q3 to buy back around 644,000 shares.
And they still have authorization left.
Yep, about $2 billion still available under the current program, so they clearly see their own stock as a good investment at current levels.
So you've got strong cash flow, enabling innovation, strategic M&A or investments, and returning capital to shareholders. That's a healthy picture.
Very healthy. Checks a lot of boxes for investors.
Okay, shifting gears slightly from pure financials to the strategic drivers. The CEO's commentary really hammered home the AI angle.
Oh, absolutely. He basically said Q3 was the clearest demonstration yet that ServiceNow is the AI platform for business transformation. They are fully leaning into that identity.
And the product announcements seem to back that up. The AI Experience UI.
Yeah, they unveiled that. Sounds like a move towards a more context-aware, sort of multimodal way of interacting with enterprise AI, moving beyond just filling out forms.
And the Zurich platform release also packed a punch, innovation-wise.
It did. New developer tools were a highlight. They mentioned enabling secure vibe coding. What exactly is that?
Yeah, vibe coding. It's their term. Sounds a bit funky. But the idea is letting developers use more natural conversational language to build things on the platform instead of just traditional code.
Okay, so lowering the barrier to create things, potentially speeding up development.
Exactly, while also building in guardrails, like their ServiceNow Vault console, for governance and security, especially around sensitive data used with AI.
Makes sense. AI needs trust and control in the enterprise.
Beyond their own tech, partnerships looked really key this quarter, too.
Definitely. That OneGov agreement with the U.S. General Services Administration, the GSA, that seems like a big deal.
Simplifying licensing to help government agencies modernize with AI, that sounds like cutting through a lot of red tape.
Yeah, it should make it much easier for federal agencies to adopt ServiceNow tech, potentially accelerating that whole public sector digital transformation push. Huge potential market.
And on the tech side, they deepened the NVIDIA partnership. Critical for the AI infrastructure piece.
Right. They introduced something called April 2.0, a next-gen AI model, and integrated with NVIDIA's AI factory architecture.
So basically making it easier to deploy powerful AI agents that run efficiently on NVIDIA's hardware, like plumbing work, but essential plumbing.
Exactly. Making AI deployment smoother, more out of the box for customers.
We also saw specific industry collaborations, like with FedEx DataWorks.
Building AI-powered supply chain workflows. That's about embedding their tech deep into specific vertical processes. Very strategic.
And that embedding theme carries through to their investments, closing that huge $750 million investment in Genesys.
Yeah, Genesys is a major player in AI-powered customer experience, contact centers, that sort of thing. That's a massive bet on the future of AI and customer service.
And a smaller but targeted investment in Zaylab, too.
Right, focused on accelerating CRM and AI modernization specifically for manufacturing and tech companies, shows they're picking their spots in key industries.
Okay, so summing it up, Q3 was strong, beat expectations, driven by the core business and this accelerating AI adoption narrative. They're investing heavily to own that AI platform title.
No doubt. But there's a slight nuance we need to talk about regarding the forward look, specifically Q4 guidance.
Okay, what's the catch? Or the context, maybe.
Well, despite how strong Q3 was, they were careful to mention they factored in some potential headwinds into the Q4 numbers they gave.
Like what? Macro concerns.
Specifically, yeah. They mentioned accounting for potentially tightening budgets and, maybe more immediately, near-term deal timing impacts from the recent government shutdown affecting their U.S. federal business.
Ah, okay. So even with the beat, they're acknowledging some potential bumps in the very near term, especially in government contract.
Exactly, which is why, for example, that Q4 target for non-GAAP CRPO growth is set at 19% in constant currency.
Which is still strong, but a slight step down from the 20.5% they just delivered in Q3.
Right. It reflects that caution, that slight hedge against macro factors or deal timing slips.
Okay, so that brings us to the final thought for you, the listener. Given this massive push to be the AI platform, all these investments in NVIDIA, Genesis, the new UI, how might ServiceNow's growth actually look different over the next year or so?
Think about where the growth came from this quarter. Net new ACV was dominated by technology workflows, that was 53%. Then CRM core business workflows were 24%, and creator workflows 23%.
Pretty balanced across those latter two, but tech still leads.
Right. So the question is, as these big AI bets, especially around customer service with Genesis and maybe the low-code, don't-code creator tools, really hit the mainstream, will that distribution change? Will AI become so foundational that it lifts all workflows more equally? Or will we see certain areas, like maybe CRM, really surge ahead thanks to these new AI capabilities?
Something to definitely watch as they integrate these new technologies and partnerships. How does the shape of their growth evolve?
Exactly. Something for you to chew on.